All right, let's jump right in. Today, we're putting on our expert analyst hats for a deep dive explainer on Goldman Sachs. We're going to take this absolute titan of the financial world and run its stock through some of the most famous, battle-tested investing frameworks out there. We're talking the distinct philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, and then we're going to cap it all off by running the numbers through modern discounted cash flow models. So, by the time we wrap this up, we'll have a truly 360-degree view of what this stock is actually worth.
Here is our roadmap for the analysis. 1. The Goldman Sachs snapshot. 2. The Warren Buffett lens. 3. The Peter Lynch lens. 4. The Benjamin Graham lens. 5. DC and other models. And finally, 6. Synthesis and final recommendation.
Starting right at the top with Section 1, the Goldman Sachs Snapshot Baseline Financials.
Okay, let's look at the baseline 2024 data to see exactly what we're working with here. Goldman Sachs, ticker GS, had a pretty incredible year. They pulled in $53.5 billion in net revenues, which is a 16% jump year over year. Earnings per share surged to $40.54, and their book value per share is sitting around $326. Now, here is a crucial detail. Our source material recommends a $550 to $600 price target, and they explicitly note that this represents a 15 to 25% upside. If we reverse engineer that math, it gives us an implied current stock price of roughly $478. Keep that 478 number locked in your mind, because it's going to be our anchor as we test these different models.
Moving on to Section 2, the Warren Buffett lens, moats and owner earnings.
You know, there's a really fascinating tug-of-war going on in Goldman's business model when you look at it through Buffett's eyes. Buffett wants a durable economic moat, right? And Goldman absolutely has one. They hold premier global market-leading positions. Their asset and wealth management division makes up 30% of the business now, bringing in this really sticky, durable, fee-based revenue. But on the flip side, Buffett also demands consistent earnings, and the risk here is Goldman's heavy exposure to volatile markets through its global banking side. Those earnings can really bounce around depending on the macroeconomic weather.
But let's talk about the profitability metric Buffett actually cares about most: owner earnings. For a major bank, free cash flow to equity is a pretty fantastic proxy for that. It's basically the actual cash available to shareholders after all the bills are paid. Goldman is projected to generate a staggering $9.7 billion in free cash flow to equity in 2025. Plus, the return on equity improves significantly to 12.7%. To a guy like Buffett, that ROE signals that management is deploying shareholder capital incredibly efficiently. Given this robust return profile, the Oracle of Omaha would likely see our $478 current price as offering a very comfortable margin of safety.
Next up, Section 3, the Peter Lynch lens, categorization and PEG ratio.
So Peter Lynch famously loved to categorize his stocks. If he were looking at Goldman today, he'd likely label it a hybrid, a cyclical stalwart. It's cyclical because, yeah, its earnings ride the wave of the broader economy. We literally saw EPS go from $59 in 2021, way down to $22 in 2023, and rocket back up to $40 in 2024. But underneath all that surface-level volatility, you've got this massive, virtually unshakable stalwart foundation of steady institutional wealth management.
Now let's look at the math behind Lynch's absolute favorite metric, the PEG ratio, because things get wild here. Goldman's price-to-earnings ratio sits at a super modest 10.5, but their 2024 EPS growth was a staggering 77.3%. When you divide that PE by the growth rate, you get a PEG ratio of just 0.13. Lynch typically viewed anything under a 1.0 as undervalued, so 0.13 is essentially off the charts. Now, we do have to assume neutral industry averages for insider and institutional buying since our source data doesn't break that out. But even with that assumption, an improving balance sheet combined with a 0.13 PEG ratio would be a screaming buy signal for Peter Lynch.
All right, Section 4, the Benjamin Graham lens, the mathematical margin of safety.
Ben Graham was all about the cold, hard math. Walking through his exact intrinsic value formula step by step establishes a very strict ceiling for us. The formula is the square root of 22.5 multiplied by earnings per share multiplied by book value per share. So we plug in our numbers, 22.5 times 40.54 times 325.97. Run the calculation, and boom, we get a Graham number of $545.28. According to Graham, this is the absolute maximum price a defensive investor should ever pay. And since our current implied price is $478, we are sitting comfortably below that ceiling, which gives us a really nice mathematical margin of safety.
But wait, Graham doesn't just stop at the formula. He demands a stock pass a strict defensive checklist. Adequate size? Yes, passed. Strong financials and earning stability? Passed. Moderate PE? At 10.5, it's well below his strict limit of 15, so that's a pass. There is actually one single hiccup. Graham demands a price-to-book ratio no higher than 1.5, and Goldman is sitting slightly elevated at 1.57, so technically it fails that one check. However, our sources correctly point out that book value doesn't always reflect true economic value for modern financial institutions. So all things considered, Graham would likely still approve this as a solid, undervalued play.
Let's move into the modern era with Section 5, DCF and other models, Modern Quantitative Valuation.
The discounted cash flow, or DCF method, throws out the historic assets and values a company based purely on expected future cash flows. Our source runs a detailed projection spanning 2025 to 2029, using a base weighted average cost of capital, which is essentially the return the market demands, of 11.25%, alongside a terminal growth rate of 2.5%. The base case yields an intrinsic value of just $388.46. Even if we tweak those assumptions to a highly optimistic high-case scenario, that fair value only creeps up to about $428. You're probably noticing a trend here. All of these strictly cash flow-based figures are notably lower than our $478 market price.
Now, valuing banks purely on cash flows is notoriously tricky, so it's best practice to also look at relative valuations against industry peers. A price-to-earnings approach gives us a fair value of roughly $446. A price-to-book multiple gives us about $384. If we blend the DCF and these multiple base models together, we arrive at an average target price of around $406. So, the modern quantitative cluster is definitely telling a much more conservative story than the current market price implies.
And that brings us to our final stop, Section 6, Synthesis and Final Recommendation.
Putting all these distinct frameworks side by side reveals a really fascinating split. It's like a giant puzzle where the pieces represent different investing philosophies. On one hand, you've got Ben Graham's optimistic historical asset-based valuation setting a high ceiling of $545. On the other hand, the forward-looking quantitative models are clustered down in that much more conservative $388 to $445 range. With the current assumed price sitting smack in the middle at roughly $478, the value you see entirely depends on which lens you choose to look through.
So what's the verdict? Well, the analyst in our source material issues a definitive buy rating with a $550 to $600 target. They're basically arguing the broader market just hasn't fully priced in that massive 77% earnings surge we talked about. If you're a Buffett or a Lynch disciple, the durable moat in that outrageously low PEG ratio make this a solid buy right now. If you're following Graham, you are mathematically safe to buy as long as the price stays under $545. But if you're a strictly quantitative DCF investor, you're probably going to sit on your hands and wait for a pullback closer to that $388 mark.
So as we wrap up this explainer, here is the ultimate question you need to ask yourself. Do you trust the narrative of booming earnings growth and historical asset value? Or do you respect the strict, unsentimental cash flow reality of the DCF model? The legendary frameworks have given us their numbers, but ultimately, deciding which lens holds the real truth, well, that part is completely up to you.